All right. If you're an entrepreneur, you know there's a world of difference between just surviving and actually having a strategy for growth. And a lot of that difference, it comes down to really truly understanding two core numbers. So today, we're going to break them down. Let's dive in.
Okay, let's just jump right in with a big question. Think about it for a second. With all the dashboards, all the metrics you could possibly track, what is the single most important number for a brand new business? You might think it's revenue, right? Or maybe profit?
Well, it's actually something way more fundamental. It's what I like to call your survival number. This is the point, that magic moment where you officially stop losing money. This isn't some boring accounting term, This is your first real finish line. It's huge.
And yeah, that survival line, it has an official name. So for part one, we're going to get right into it, finding your break-even point.
So the break-even point, or BEP for short, is pretty much exactly what it sounds like. It's that sweet spot where your total sales perfectly match your total costs. You're not making a profit yet, but, and this is the really important part, you're not losing money either. You've basically covered all your bases. It's the starting line for being a sustainable business.
Okay, so how do we actually find this number? Well, it all starts with understanding your costs. And really, they fall into two main buckets.
First up, we've got your fixed costs. The easiest way to think about these is they're the bills that show up every single month, no matter what. It doesn't matter if you sell 1 million widgets or 0 widgets, you still got to pay them. We're talking rent, salaries, your insurance, the cost of just keeping the lights on.
Then, on the flip side, you've got your variable costs. Now these costs move up and down directly with your sales. The more you sell, the more you spend. It's a direct relationship. If you have a slow month and sell nothing, well, these costs are pretty much zero.
Let's make this super concrete, okay? Imagine you're running a t-shirt business. Your fixed costs, that's the rent for your shop, maybe the salary for your designer. You have to pay those even if you don't sell a single shirt. Now, your variable costs, that's the blank t-shirts themselves, the ink, maybe a sales commission. The more shirts you print, the more of that stuff you have to buy. Makes sense, right?
Okay, stick with me. There's just one more piece to this puzzle. It's called the contribution margin. So after you make a sale and you pay for the variable costs of that specific item, like the blank t-shirt and the ink, the money that's left over is your contribution margin. It's not profit yet. It's the cash that each sale contributes towards chipping away at that big pile of fixed costs for the month.
And when we put all that together, we get this really simple two-step formula. First, you figure out your contribution margin for just one item. That's just the sale price minus the variable cost for that one thing. Easy. Then, for step two, you take your total fixed cost for the month and you divide it by that contribution margin number. And voila! The number you get is the exact number of units you need to sell just to break even.
Look, the bottom line here is this. Once you know this number, you are no longer flying blind. You're not just guessing anymore. You have a real, tangible target. You know exactly what the finish line looks like to make your business financially stable. That is incredibly powerful.
But hey, just surviving isn't the goal, right? We want to thrive. So let's move beyond just survival and talk about strategy. This is where things get really interesting. In part two, we're going to talk about something called operating leverage and how you can use it to really pour gas on your growth.
So what is operating leverage? In simple terms, it's a way to measure how sensitive your profits are to a change in sales after you've hit your break-even point. And the analogy here is just perfect. Think of your fixed costs as the fulcrum, the pivot point of a lever. Once you've covered them, every little bit of sales you add can have a huge effect.
And this, my friends, is where the magic really kicks in. Because once those fixed costs are paid off for the month, every single dollar of contribution margin from every new sale, it goes straight to the bottom line. It's pure profit. So a small bump in sales can lead to a massive, just disproportionately huge jump in profitability.
So what this all means is that you have a strategic choice to make. Let's take a company with high fixed costs, say a software company with a huge team of expensive developers. They have high operating leverage. It's risky? Sure, because they've got this massive payroll to cover. But the potential reward is explosive. On the other hand, think of a freelance consultant with very low fixed costs. Their risk is way lower, but their growth is going to be a lot slower, a lot steadier. And you can just see the difference. For the exact same increase in sales after breaking even, that high leverage business sees its profits go through the roof. The low leverage company, they see nice, steady growth. It's important to get this. Neither one of these is better. They are just two completely different strategic paths.
So let's bring this all home. What's the big takeaway? It's that your cost structure, that mix of fixed and variable costs,
is so much more than just a line item on a spreadsheet for your accountant.
It's a fundamental strategic bet. It's a bet on your business model. It's a bet on how many sales you think you can make. It's a bet on your market. And maybe most importantly, it's a bet on your own personal appetite for risk.
And that really brings us to the final question you should ask yourself. Knowing all this, what kind of business are you really building? Is it a high-risk, high-reward speedboat designed to just take off once it gets up to speed? Or are you building a steady, reliable cargo ship built for a slower but maybe more predictable journey? There's no right answer, but the choice is absolutely yours.